All right, let's get right into it. Today we're going to break down a really interesting strategy from a source called elite options trading. The whole idea is to pull back the curtain on how the big institutions play the game, which, trust me, is a completely different world from how most of us trade.
So, right out of the gate, the source hits you with this question. It's basically saying, hey, what if the secret sauce isn't some magic indicator, but just a totally different way of thinking? So yeah, let's find out what these three pillars actually are.
Okay, but before we jump into the deep end, we gotta talk about this. The source itself puts this big disclaimer right up front. Everything we're talking about here, it's purely for educational purposes, all right? We're just breaking down their ideas. This is definitely not financial advice. You've got to do your own homework, always.
All right, pillar one. It's all about true direction. Now you might think, direction, easy. Is the stock going up or down? But that's not what they're talking about here. Not even close. This goes way, way deeper.
And this slide, wow, it just lays it all out, right? On one side, you've got the typical retail approach. We're all looking at charts, indicators, news, stuff that's already happened. But on the other side, the institutional tactic is all about looking forward. They're analyzing what they call layered flow. And what does that mean? It means they're not asking, where is the price going? They're asking, where will the big dealers be forced to hedge their bets? It's about a chain reaction. That's a total mind shift.
And look at this. This just drives the point home. See that tiny sliver for price action? For the big players, that's just a small piece of the pie. The real action, the stuff they're obsessed with, is dealer gamma exposure. That's basically how fast dealers have to rebalance their books, and options open interest, which shows where all the big money is parked. This is like looking at the markets plumbing. You know, it shows you where the water has to flow.
Okay, so that's direction. Now let's move on to pillar two, because this is where it starts to get really strategic. If you know where the market is likely being pushed, the next logical question is when. This pillar is all about strategic timing.
Right. So what's the big idea here? It's all about being smart with your time. The source makes a great point. A lot of traders buy an option and just hold on for dear life, right? But while you're holding, you're bleeding value every single minute because of something called premium decay. The institutional move, it's totally different. They're like snipers. They wait for these very specific moments, these liquidity windows, when a massive surge of volume is going to force a big move. It's not about spraying and praying, it's about one perfect shot.
And they don't just leave it vague either. The source points to two very specific time slots. First, you've got that morning reversal window. You know, when all the overnight hype either fizzles out or gets real. And then there's the late-day institutional hedge. This is when the big funds have to square up their positions before the closing bell. The idea is, if you trade inside these windows, you're not fighting the current. You're riding the biggest waves in the ocean.
And that brings us to the third and, maybe the most critical pillar of all, calculated risk. I love how the source puts this. It's not about trying to win every single trade. It's about playing the game in a way that guarantees you can show up and play again tomorrow. Man, this is a big one. We've all seen it, right? The all-in YOLO trade that either makes you a hero or blows up your account. The source says that's a recipe for disaster. The institutional mindset is completely different. It's all a numbers game. They're hunting for trades with asymmetric risk. In simple terms, they're looking for opportunities to risk $1 to make 5 or 10 or more.
This chart makes it super clear. Look at that. You risk this tiny little bar, just 1 unit, but your potential reward, it's a skyscraper next to it, 5+ units. When you think like this, you don't even have to be right all the time. You could be wrong 3-4 times in a row, but that one big winner can wipe out all the small losses, and then some. It's a marathon strategy, not a sprint.
Okay, so let's recap. We've got direction, timing, and risk. Those are the pillars. But how do you put them all together? Well, this is where the source unveils its secret weapon, something they call the dealer trap map. This is supposedly the strategy that ties everything we've talked about into one single actionable plan. Now, to get the map, you first got to understand this concept, the liquidity void. So picture this. The market has these giant walls at certain prices, where tons and tons of options contracts are stacked up. The dealers, the market makers, they want to keep the price kind of stuck near those walls. But what about the space between those walls? Often it's empty. There's nothing there. The source calls that a void. And when the price gets into that void, it can move fast, like scary fast, because there's nothing there to stop it.
And boom, here's the strategy in 3 dead simple steps.
Step 1, you use the data to find where those massive gamma walls are. Step 2, you spot the empty space, that liquidity void, right between them. And Step 3, you plan your trade to catch the exact moment the price breaks through and starts sprinting across that void. The source compares it to finding a secret empty superhighway right next to a traffic jam. It's a pretty powerful idea.
So, you see what's happening here? When you start to put all these concepts together, it's not just a collection of tips. It becomes a whole new framework, a different way of looking at the market entirely. You stop chasing news and start.
So let's put it all in one place, the whole system. You get your direction by watching what the dealers are forced to do. You get your timing by hitting those specific institutional windows. You manage your risk by always aiming for that asymmetric payoff. And your edge, your special advantage, that comes from using the dealer trap map to trade those wild moves in the liquidity voids.
And that's pretty much the whole playbook in a nutshell. Now, the source material we're looking at, it comes from a channel called Elite Trading Radar. And at the end of their breakdown, they ask their viewers, if you found this valuable, like the content and subscribe to their channel for more of these kinds of institutional tactics.
So I want to leave you with this one big question. The entire strategy we've just walked through, it all boils down to one simple shift in perspective. What if you stopped looking at the market as just a price chart and started seeing it as a map of obligations? A map of where the big money has to go. Could that single change fundamentally alter how you see everything?